Join me as I dig into the world of required minimum distributions and see if I can figure out just how they're stealing your hard-earned cash. If you're a retiree or nearing retirement, you've probably heard of required minimum distributions, or RMDs. Essentially, RMDs are the minimum amounts of money you're required to withdraw from certain retirement accounts, like 401s and IRAs, every year. The idea behind RMDs is to ensure that people don't hoard their retirement savings and avoid paying taxes on them. RMDs can pose significant challenges to your retirement savings. One major issue is the tax implications. Since RMDs are considered ordinary income, they're taxed at your income tax rate. This can increase your tax bill and potentially push you into a higher tax bracket. For example, if you have to take a large RMD, it could bump you up from the 12% tax bracket to the 24% bracket, which can have a big impact on your finances. Another challenge with RMDs is that they force you to withdraw money from your retirement accounts, whether you need it or not. This can be problematic if you're not using the money and would rather let it continue to grow tax-deferred. For instance, if you have a solid pension or other sources of income, you might not need the money from your RMD, but you'll still have to take it. The forced withdrawals can also impact your investment strategy. You might have to liquidate investments that you wouldn't normally sell, just to meet the RMD requirement. This can lead to missed opportunities for growth and potentially lower returns on your investments. To understand how RMDs work, you need to know the rules. The government requires that you take RMDs starting at age 72, or 70 and a half if you were born before July 1, 1949. The amount you have to withdraw is based on your account balance and life expectancy. There are tables provided by the IRS that you can use to calculate your RMD. One common misconception about RMDs is that you have to take them from every retirement account. In reality, you can take your RMD from just one account, which can make managing your withdrawals more efficient. Another misconception is that you can delay taking your first RMD. If you delay, you'll face a 25% penalty on the amount you should have withdrawn. Some people think that RMDs only apply to certain types of accounts, but that's not entirely true. While RMDs do apply to 401s and traditional IRAs, they don't apply to Roth IRAs. However, there are some exceptions and special rules for inherited accounts and certain types of employer-sponsored plans. The good news is that there are strategies to minimize the impact of RMDs on your finances. One approach is to take advantage of tax loss harvesting in your non-retirement accounts to offset the taxes on your RMD. You can also consider converting some of your traditional IRA or 401 to a Roth IRA, which can reduce your RMDs in the future. Another strategy is to use the Qualified Charitable Distribution or QCD rule. This allows you to donate your RMD directly to charity, which can help reduce your taxable income. For example, if you have to take a $10,000 RMD and you donate $5,000 to charity, you'll only have to report $5,000 as income. You can also consider delaying retirement account contributions or using other investment vehicles that don't have RMDs. Annuities and certain types of trusts can provide a steady income stream without the burden of RMDs. In summary, RMDs can have a significant impact on your retirement savings, but being informed can help you protect your finances. Understanding the rules, challenges, and strategies surrounding RMDs is crucial to making the most of your retirement. So, what do you think about RMDs? Have you had to deal with them in retirement? Share your thoughts and experiences in the comments below. And if you're interested in more retirement planning strategies, check out our video on how to create a sustainable income stream in retirement. Thanks for watching.